Alright, so thanks again for joining, guys. So hopefully your screen and everything is working. So thank you guys for taking time out of your Sunday. Pretty much again, just in this class, just gonna go over option basics, right? What exactly is an option contract? What does it look like on the option chain? How you can really trade it and get in and out with options, right? Option trading has become very popular in the recent years. It started off as just being a hedging instrument that a lot of traders would purchase to kind of safeguard against their stock purchases, right? So that's how kind of options kind of first entered into the market. But because of the rise of technology, because of the rise of the retail trader, options have become very popular with the companies and a lot of strategies, right? One for the very basic, it's used as speculation, right? Quick entries and exits due to the volatility in their premium price leads to a lot of widespread retail day trading. And there's also a lot of complicated strategies, right? Like Harpreet mentioned in that Thursday session, you can do complex strategies like covered calls, naked puts, butterflies, iron condors. There's a whole plethora of strategies that you can use that just revolve simply around options. So just pretty much want to talk about it. I will also say that options do carry a very, very, very high level of risk, sometimes higher than stocks, as they could, lose their value very quickly because option prices, those premiums, they're very volatile. They can go up and down quickly. They can also blow your accounts very quickly as well. And sometimes you have a lot of like famous traders like Warren Buffett and like a lot of your value investors that see option speculation as gambling, and in a way it is, just because again so much of the risk is already against you. So you have to really know what you're doing. You have to really have a high knowledge base, a high investment experience in order to trade options, right? So I do recommend before getting into it, make sure you guys understand what exactly you're trading. You make sure you understand the volatility and all the risks associated with options. If you guys want a clear breakdown, if you guys check out in the Discord channel, going to that disclaimer channel, there's also a breakdown of all the risks between options and futures, right? So just know that it is very risky. Just note that if you guys do plan to trade it, make sure you guys have that knowledge, have that experience, and you just practice. You see how option contracts move before jumping in head first, right? So exactly what is an option, right? So we'll start off with the basic definition. So an option contract is a derivative, right? What is a derivative? A derivative just means that it's a financial instrument which value is derived from another asset, right? For example, futures contracts, right? Futures contracts are a derivative because you have futures that are based off the indices like your ES, which is based off the SPX. You have the NQ, which is based off the NASDAQ, the NDX, and you have things like crude oil, which is like CL, which is based off crude oil futures, right? So similar to that, you have options, which are also derivatives, right? You can have SPX options, SPY options, which are based off of major indices. You can have NVIDIA options, Tesla options, which are tied to the stock price, right? So as the stock price moves up and down, so will the option premium, the options value, right? So options are a derivative and it's a contract between a buyer and a seller. So that's kind of different from your shares as well, right? When you purchase a share, you're purchasing actual ownership, right? You pay for something, then you get an actual asset in return. Whereas an option isn't really an asset, it's a contract, right? You as a buyer are just simply paying for the right or the right to do something, right? Either to buy or sell the underlying asset at a specified price by a certain date, right? And then the seller is on the opposite end and they have to meet that obligation, right? So for example, let's say you have a option contract out there. You as the buyer will pay a premium, right? So an upfront charge, say like 170 $200, which will then guarantee the price at which you can sell or buy an underlying asset like the stock at a specified price by a certain date, right? So for example, let's say you have a put option, right? A put option, as you can see here, gives the buyer the right to sell, right? So if you think about what options were originally used for, they were used for as a hedge. So let's say we have a big player and they purchased a company for like, let's say $100, right? And they want to guarantee that, if when the price goes up, they want to guarantee that they can sell that. For $95. Say the stock was to go down, and it used to kind of goes down pretty dramatically. They want to guarantee which price that they can sell at, so they minimize their losses, right? So they buy a put option for that 95 strike price, right? So that 95 strike price is the guaranteed price at which they can sell at, prior to the deadline of that option contract hitting, right? So for them to get that right, for that obligation to sell, they will then pay the option writer, the option seller, a premium price, right? And that premium price could be, let's say, for example, $170, right? So the buyer pays the the put writer $170 for the right to then sell that share of the company at $95 if it were to hit that, right? So let's say the stock price then goes and moves and the stock continues to move higher, right? It goes from 100, it goes to 105, it goes to 110, 115. It gets further away from that 95 strike price. Well, if you think about it, why would the buyer of that contract then, sell for lower than what they can actually do for in the market, right? So for that reason, the put option, right, is worthless. So in that case, the seller, or the writer of the option, will bank on that premium, that $170 that he took initially from the buyer, and then he'll make a profit off of that. If the stock were to drop, right, it's supposed to go from 100 to the 95 and then it hit $90, well, then the buyer of the option has value, right? Because they could sell that stock for that $95 versus the market price, which is 90, right? And then the writer will then face a loss because they have to meet that obligation, right? If they're selling for $95, then the buyer has to pay $90 for that stock, sorry, $95 for that stock, regardless of what the current market price is, right? So that's pretty much what an option contract is, right? It is a contract between a buyer and a seller where the buyer will pay a premium for the right, not the obligation though. So they don't have to, if the stock, moves away from their exercise price, they don't have to exercise it, right? So they're just paying for the right, but not the obligation to sell the underlying asset at a specified price by a certain date, right? So the premium price is typically what speculators and day traders, what they will move, right? Because that premium price, right, is derived from these assets. If you think about it, like Nvidia, how volatile it is, right? It moves up and down like in large amounts, and it has a large range of price volatility. So the premium price kind of is that, but magnified, right? So it does lead to, for that reason, a lot of speculation and a lot of quick in and outs. And it's popular for day trading, and I'll put myself in that boat. I don't really trade options for those complex strategies like iron condors and butterflies and covered calls and stuff like that, just simply because it wasn't really anything I got into. For it, you really need to have a good, keen sense of your maths in order to calculate your risk and return probabilities, and you just need to be more actively managing it as well, right? Every weekly or so or monthly, depending on what you play, as the contracts come near that expiry, that deadline, you then have to kind of roll over, which requires a bit more active management. So for that reason, I never really got into all those complex strategies, but I do sometimes occasionally, if we're seeing some nice range on the triple Qs, or we're seeing some nice range on the Nasdaq or on the SPX, or say Nvidia has some volatile news coming up or something like that, then I'll tend to kind of play options. I'll speculate, on those quick in and outs. But typically falls in those two boats. But as a trader, we're pretty much focused on that premium price. We're not really ever too interested in exercising the option or kind of collecting on that unless you are playing with some of those complex strategies, right? So you want to focus on what the exercise price is, right? That's a specified price that the buyer or the seller agree upon before at the formation of the contract, and it's the price that must be settled at the execution of the contract, right? And the deadline is just the expiration date. Typically, options, you have a multitude of different expiries. You have daily options, which are called zero DTEs, which are primarily used by day traders and speculators. You'll hear some things like sometimes like on SPX, 0 DT expiries. That's kind of big traders kind of positioning themselves for those quick in and outs on speculation, right? Then you have kind of weekly contracts, you have monthly contracts, you have quarterly contracts, and you have yearly contracts as well. So the expirations do tend to vary, but it's make sure that you understand that as the contract gets closer to that expiry, it does tend to lose value, and we'll talk about that in a bit as well. Basically, I just want to understand what is an option contract, right? So it is a contract between a buyer and a seller. The buyer pays a premium that then has the right to then sell or buy depending on the option is. If it's a call option, it gives the owner the right to buy the stock at a specified price. If it's a put option, it gives the buyer to sell at a specified price. Okay. So much very different from shares. I don't want you guys thinking that if you buy an option, you're buying that asset. You're not. You don't technically own anything. You're just paying for the contract for that right or that obligation to then pay for a specified price by a certain date. Okay. So as day traders, we're focused on that premium price. If you focus on more complex strategies, then you're actually focusing on what the exercise price and those deadlines are as well, right? So typically, this is what a option chain looks like. So when you go to your broker, say you want to purchase a option, this is typically what you will see ahead of you, right? So let's say you go to ABC stock, right? And ABC stock, the current price is $107. That's listed on the exchange, right? It's moving up and down quickly. Factors of demand and supply are hitting. The stock is moving, and this option chain is constantly moving up and down as well. So what you see kind of in the middle are all your strike prices, right? These are the strike prices available that say you want to buy or sell the option at that specified price, right? So let's go on, and then On the left side here, you're gonna have calls. So these are your call options. And then the right side, you're gonna have puts, and these are your put options, right? Now, each contract has their own specified bid and ask. Each contract has their own, book that undergoes their trading, right? Because each contract is their own individual thing, right? So if we look, for example, here, this is the 105 strike price, meaning that by the deadline, I will either, buy or sell at this strike. And if you go on the left side, this is a 105 call, right? So let's say you want to purchase a 105 call. You would go here on the option chain, you would click on the bid or the ask, right? Bid being the highest price that a buyer is willing to purchase for the option, and the ask is the lowest price that the seller is willing to sell for that option, right? So when that bid and ask match, then you own the asset, own the financial instrument. So in this case, if you see the 105 call option, then you kind of purchase into that bid or ask on that side, right? So, and if you want to buy a 105 put and you want to have the right to sell, then you go on the right side here and you purchase on the bid or ask on the put side of things, right? So you can see that we're kind of listing all the strike prices down in the middle. On the left side, you got your calls. On the right side, you got your puts, right? So you can also see here that they're saying out of the money and in the money. So what does that mean? So typically, if you go back, right, let's say you purchase a 105 call option here and the current market price for the stock is at the 107, right? That means that your call option is in the money, because if you were to exercise that option, then you would only be paying $105 for that stock, right? Whereas the current market price is that 107, right? And you paid a premium. So you paid this 450 for that right to then purchase that stock for that 105, right? I'll also add that these premium prices you'll see listed here kind of as 450 or $2 or 150. That doesn't mean you're paying $1.50. Typically, the minimum order size that you have to do when it regards to option is 100 times whatever that price is, because one contract represents 100 shares, right? So say it's 450, you would actually have to and you want to buy one contract, you want to buy the 105 call, you'd be paying $450, right, at that ask price. Okay, so typically you pay that premium, and then you get that right to exercise it. So this 105 being lower than what the current market price is indicates that that option now is in the money, right? And in the money does carry certain characteristics. The premium does tend to move high and lower pretty quickly, and we'll talk about some of the option Greeks as well. But typically, if you buy something out of the money, right, that just means that the current strike price is higher than whatever the current market price if you're buying a call, right? Because why would you exercise your option to pay for more than something than you could just do so in the market price, right? Why would you pay a premium and then pay more on top of that, right? So then any call option that's above the current market price is known as at the money, right? And then puts are kind of the inverse, right? Because the puts give you the right to sell something. So let's say if the current market price is 107, you want to buy a 105 put option, right? You pay that $222, right? Why would you then sell for something if you can sell that asset for higher in the market price, right? Why would you take a $2 loss off the top by purchasing a put option that is out the money, right? And we see those kind of put options that are above the current market price. Those will be in the money, because then you can sell for higher than whatever the current market price is, right? So if you were to buy the 110 put option, you'd be paying a premium of $400 to then sell that stock that you have for 110, which is $3 over what the current price is, right? Your put option is in the value, it is in the money. Okay, so that's pretty much the difference. Pretty much, if you buy a call option, you're hoping that the stock price goes higher, because then your call option will be in the money and you could purchase it for what's cheaper than the current market price. And if you buy a put option, right, if you're a buyer, then you're wishing for the stock to go lower, because then your put option would have a higher price than whatever the current market price is, and it'll be in the money, and you could sell, you can offload those premiums, right? Depending on what you're doing. If you're a writer, then obviously you want the opposite. You want to bank on those premiums. Say you write a call option, then you want the stock price to go down, because if the stock price goes down, your call option will move further out of the money, and you can then profit on those premiums, right? You say you paid 105 and you pocketed that 400. Say you're the writer now, right? And you're selling a 105 call option. Well, then you pocket that 450, right? That goes into your pocket, and then as the stock price kind of dwindles down out of the money, the premiums start to decrease, and it'll slowly go to zero as it approaches expiry, and you pocket those gains, right? So that's pretty much how kind of call options and put options work. Again, their values are derived from the underlying asset, and it also depends heavily on what strike price you buy, and if it's in the money, at the money, and stuff like that. Okay. So again, pretty much, as you know, there's two camps that you can fall into. Either you can, do those strategies, iron condors, covered calls, focusing on that risk return, right? You can pre-identify what your risk is going to be, or you can fall in the boat of speculation, where you're just trying to capitalize on those quick gains in that premium price. But ultimately, what goes into that premium price, what affects, the premium, what makes it go higher, what makes it go lower. And for that, you can refer to what's called the option Greeks, right? So the option Greeks are pretty much like certain characteristics that you can find on the option that tells you pretty much, how that premium is reflected due to a change in some external factors, either in the stock or in any sort of external macroeconomic factors, right? So the first is delta, right? So delta pretty much measures how much the premium changes for a $1 move in the stock. If you have a option premium, if you have an option contract with a high delta, that indicates that it's more volatility in that premium price. Typically, your stocks that are more volatile in nature or have a higher what's called IV, which is implied volatility, then those will have a higher delta attached to them. For example, stocks like Tesla, right? Tesla is a very heavy tech-based company. It does see a lot of range in its price action from the intraday movements due to the large amount of volume that is traded in the option as well, right? So that higher amount of implied volatility indicates that the premium prices will jump up and down a lot more as well. So you see typically, the delta on your more high tech related companies would be much higher than on deltas related to, like, say, your financials or your industrials, which really don't see that much range in that price action, right? So delta is very important to keep eye on, and just kind of pretty common sense, right? For deltas on call options will be positive because the call premium will go up when the stock goes up, right? If the stock goes higher and continues to rise, your call option will get further in the money because then you can purchase a stock for cheaper than what the current market price is, right? So then your delta would be positive. The value of your premium goes up as the stock price goes up, right? And as the delta, as your stock is more closer to in the money or around the money, then you'll see higher deltas. If your stock is more out of the money, if your contract is more out of the money, then they typically attach a low delta. You don't see that much movement in your premium. So that's why typically for day traders, what you want to look for when you see that option chain is typically you want to trade something that is closer to what the current stock price is, which is called at the money, and you want to see what the volume is. If you have a high volume and it's something that's close to in the money, then that's typically what's mostly used for your day trading over your speculation, right? And that's just because those stocks have a higher delta attached to them, right? The second Greek is gamma. Gamma just measures the rate of change in delta as the stock moves. So think of it as like your gas pedal. If you have a high gamma, then that means that that traders are putting their foot on the gas, that contract has a lot of traction, it's getting a lot of interest, and it could see a lot more volatility in its premium price. If you're seeing a low gamma, that means that they are letting their foot off the gas. That option doesn't really have that much interest from the overall market, so it's not really going to see that much range in its price action, right? So stocks that are at the money tend to have a high gamma, and stocks that are deep in the money or out of the money have a low gamma, kind of also coinciding with the delta. So delta and gamma kind of go hand in hand, and they pretty much just measure the volatility in the premium price. If you have a high delta and a high gamma, then again your premiums carry a high level of risk because again you could profit quickly, right? I also want you guys to think of like risk and reward as a trade-off, right? If you have higher volatility and higher gamma, higher delta, then your opportunity for profits is high. You have a high probability for return, but that also comes with a high level of risk of loss as well, right? So just as quickly as you can make money, you can also lose money in these, right? The next kind of next option Greek I want to talk about is the theta. Theta measures time decay, right? So as mentioned earlier, each option carries a expiration date, right? Either it be the 0 DTEs, weekly, monthly, quarterly, yearly, whatever have you. The option contracts do expire, right? They reach a deadline, and as the stock as the contract approaches its deadline, the closer it gets, the more impact that time decay has on the stock as well. I mean, on the I keep saying as on the contract as well, right? So if we see, for example, a option contract has a month left before expiry, it will be valued a lot higher than an option contract that's kind of similar strike price, similar asset, similar everything, but with a week left, right? Will have a much lower value just because of that time decay, right? And as it gets closer to that zero marker, that 0 day, then you'll see the effect of time decay a lot worse, right? So typically, like when you see your 0 day TEs, your 0 day TE, SPX, stuff like that, typically as you get closer to that expiry, sometimes like at 2 p.m. or at 4 p.m., as the market's coming to a close, you'll see that these options start to lose value a lot quicker than they did prior, right? And that's just due to the value of time decay. It's also a lot of reason why options are extremely risky because of this factor, right? Unlike, when you have your futures contracts, which also by means are also very risky. And I wouldn't recommend, if you don't have those prop firms, to not really mess with futures as well, as they also carry, I think, the same level of risk. But futures are a little bit less risky just due to this data measurement, right? That's why, again, option trading, especially speculating, is heavily against you because time is against you, right? As you get closer to that expiry, you tend to lose more and more value in your contract. It requires more effort from the underlying stock to move in your direction in order for you to become more profitable, right? So that's why option trading is very risky. That's why a lot of traders who, they get enticed by looking at SPX because it is very popularized, right? Because you can make a lot of money and capitalizing quick moves. Like, let's say you get an SPX call option at the right moment. You see a huge spike in price, a huge spike in IV due to, who knows, say some Trump tweet coming in. You could profit substantial gains, and you could see like that those gains on Twitter, right, constantly posted. But a lot of times, if it moves against you and you're playing 0 DTEs, it can also burn you very quickly, and then you suddenly stop seeing those financial posts, those posts on Twitter happening just quickly, right? All it takes is one bad trade, and it could wipe you out pretty quickly. So data, again, is a major reason why a lot of people lose. It does require a large portion of the option premium value, right? Data and I think IV, implied volatility, are kind of major key factors. If you see a stock, typically that has a lot of volatility in it, you see a lot of range in its price, then those premiums tend to be higher than stocks that don't really see that same IV, and also that time decay. Option contracts that, everything else being the same, that has higher time left before it expires, will have a higher premium attached to it as well. All right, and the last two, kind of Vega and Rho, don't really matter too much, but can also be kind of something to keep on the backdrop. Vega just measures how much the premium changes with a 1% increase in the IV. So typically you'll see this occur during times of earnings, right? When you have a stock that is coming into their earnings report, the Vega will be kind of magnified just because there's a higher amount of implied volatility, right? Think about that. What is volatility? Volatility is just the range in price, how quickly it moves up and down. What is that established range? What is that ATR for the stock, right? And then implied volatility measures, okay, what is the market's perception of how the stock's going to move, right? So typically during times of where there's like a heavy catalyst event, like earnings reports, like say some major news hits the stock's bottom line, then that creates a large amount of implied volatility. So Vega tends to be higher, which then gets priced into that premium. So typically you'll see on stocks around times of their earnings will have a higher premium price attached to it, rather than stocks that don't really are coming into earnings or don't really have that IV attached to it. Okay, so that's Vega, and then Rho just measures how much the premium changes with a 1% increase in interest rates, right? So that's kind of just a general market-wide effect, right? If you see, with the federal funds rate, with the interest rates, how the economy is doing, that has wide effects on all assets. So pretty much the measure of how that impacts on the contract is your Rho, right? So delta, gamma, theta, vega, and Rho are all key Greeks that you can keep an eye on to pretty much determine how that premium price in that option contract is going to react, right? And you can find all this information on your brokerage depending on what you use. I was going to show you an example, but I made this presentation over the weekend, so I didn't get kind of screenshot. But I'll show you guys during the session on Monday. But pretty much you can go to like any sort of contract. Let's see if IBKR, you pull up the option chain, you go to the contract, and then I'll show you like on the top underneath the description all these different measures. It shows you IV, it shows you delta, gamma, volume, and all that stuff, which is important, if you're considering to trade it. So pretty much that's just what I wanted to go over. Again, not a long lesson, just wanted to go just quickly over pretty much just the basics of exactly what is an option, right? I know it is getting a lot of interest, and you definitely, like, covered call strategy is a good one. If you can, get them behind the mats, if you can get the knowledge behind it, and you can successfully calculate probabilities and that risk to reward, it definitely could be something that, sets up those longer term gains. I will also say you do need a lot of capital for a lot of these option related strategies as well, just because a lot of it does encompass you having to write contracts or sell contracts. And for that reason, you need to make sure that you can, meet those obligations when they come due, right? So just a quick, again, disclosure here. again, options carry a very high level of risk, right? If you are considering speculation, if you are considering, getting in and out, like, again, it is possible. Like, I do it as well. Like, sometimes when I'll see a high volatility in the stock or in the triple Qs, major indices, then I'll jump into like a triple Q call contract trying to capitalize on, quick spikes up and down in price. So it is possible to earn profits, but it is considered gambling. And if you do, trade options for speculation, you have to be okay with the trade going to zero, right? If you're gonna say pay like $120 for that premium, and then you're expecting, the call option to um, go up in value as the stock, goes up, because you're picturing the stock goes up, then you have to be okay that, okay, if it, reverses on you quickly, kind of go to that zero market, right? Just because you're fighting things against IV, you're fighting against theta, you're fighting against the actual option Greeks that are going to value that premium, a lot of those things can turn against you pretty quickly, right? So if you are considering speculation, you have to be okay with the trade going to zero. That's the level of risk you have to be willing to take, all right? If you plan to sell or write options, then you have to make sure you are prepared if your contract becomes expired, right? I'll show you guys with a little story. I'm not sure some of you guys, if you heard it already, you guys can intervene if I'm getting some of the information wrong. But a couple years ago, there was someone who had, wrote wrote put options on the SPY, and they had, sold these put options to a buyer, right? And as it got close to the expiry, those put options actually were in the money, right? So they had value, and as they were coming close to expiry, the trader didn't realize, and the opposite end of the order, the buyer, he decided to exercise his option, right? The exercise option to sell as they were in the money. So he exercised the option to sell, and then what the writer saw was on their contract, because again, the broker can assign it to you whenever, right? If you have a contract that's in the money, just be careful you're managing it, because the broker could assign it to you, where if the other side executes the order, then you have to meet that obligation. So this person, he wrote sell options, right? He put them on the exchange. Someone bought them, and then as they got too close to expiry, they were in the money, and the buyer decided to exercise it, right? So what this trader saw then was on their account, because they have to purchase they have to purchase the underlying asset, right? If someone's selling it, they have to then buy it, and then what they saw on the brokerage account was a huge minus, right? A huge negative, as they had to buy all these shares, and they actually panicked. And pretty sad, what ended up happening is they took their own life, right? Because they didn't know what they were doing. They didn't understand what the actual asset was. They heard from someone online, that they could make a lot of money selling options. They were hoping to bank on their premiums, and when it went money, they kind of forgot about it. But then they saw this huge minus that came out of their accounts, because they had to purchase all these SPY contracts that this person was selling. Right, minimum was 100. I'm not sure how much exactly he had, but it was a pretty significant number if I remember correctly. Right, so. And pretty much hindsight, all you had to do was wait till that Monday, and then offload those SPY contracts, and then he would have still had a loss, but it wouldn't have been as magnitude as he thought it would be, right? So I'm not saying that again that will happen to you. Just if you do plan to sell or write options, make sure you guys are prepared that if the contract does fall in the money, that you are able to meet, unless you sell it and take those premium gains. Make sure you guys are willing to fulfill that obligation. If you sell call options, make sure that you have the cash available, because if those options do get exercised, then you have to be purchasing those shares from the call buyer, right? And if you're on a put option side, you got to make sure that you have the shares available to sell it if the person decides to buy, right? So that is pretty much what I want to talk about with options, guys. Again, just the basics, 101. Pretty much just going over what exactly option contracts are, because I know a lot of people getting confused, saying that, okay, if they have an option, do they own the underlying share? It's not. You're just owning a contract, right? You have the right to exercise it or not, and just make sure you focus on that exercise price. Make sure you focus on that time decay, and I just want to go over basically a little bit on the premiums as well. So if you guys have any questions, we can go over that now. If not, I think we'll end it there. Yeah, again, just want to do basics. I don't know too much about, again, all the complex strategies about covered calls, naked puts, and stuff like that. For that, I think we'd have to ask Harpreet. He knows a bit more information in regards to that. But if you have any basic questions, then I can be happy to answer those. Mm-hmm. Yeah. Yeah. So the current, so like say for this 107 will be like here, right? And there's a call option and put options. Mhm. Yeah, so I just used it. Yeah. So I just use this example. Like this is just an image. On most brokers, it is like that, where you'll see like the current price like on the top corner somewhere, and then that would also be kind of a strike price in the middle, right? So that option, like say there was 107 here, that would be called at the money, right? So what the current price is, and if you're buying a call or put, it just purely depends on where you think the market's gonna go, right? If you're speculating that the price is gonna go up, then you're going to buy a call option, right? Because as the value of the stock goes higher, your call option, if it's in the money or at the money, will start to gain value as well, right? If you're speculating that the stock price is going to go down, then you'll most likely buy a put option because as the stock price goes lower, then your put option value will go higher. Hmm. Yep. Yep. So the premium price does change, right? The premium price will go up and down based on those different factors like delta, what's the stock price doing, what's the IV, how close is it to expiry, and it will change. And yeah, you could definitely close prior to the expiry. So what I'm saying sometimes that if it's in the money and if you have nice gains on it, just be careful because once you get close to the expiry date or at that expiry date, the broker might assign you that obligation if, it gets exercised. But if you close it before then you should be okay. Mhm. Mhm. Okay, so yeah, I'll post it. I'll post it for you. But also you can check like CBOE website, the CBOE. They have all their market timings on. CBOE, Chicago Board of something something. Yeah, but they pretty much list all their market times. But typically for options, they do run like your index options like SPX, your triple Qs. They do run in the pre-market. And then they do close from like 9:15 and then they reopen at 9:30 a.m. Eastern time. And then they trade during the regular market hours and they close, I believe, at 4:15 p.m. Eastern time. Yeah, but I'll find those exact names and I'll post it for you. Yeah. All right. Okay, cool. So if there's no more questions, guys, again, hope you guys found this informative. I just, again, wanted to do a basic understanding. So hopefully you guys have a little bit more knowledge of what exactly options are. Again, this session is recorded and I will post in the education channel. So if you guys want to watch it back or if you guys have any questions or want like a little bit more further understanding, you guys can always hit me up with a DM as well. So if not, I think we'll end it off there. If you guys have any other questions, not regarding options, if there's anything else you guys want to talk about, we can. If not, I think we'll get back to the weekend and then prepare for markets tomorrow. I think we will be doing a live later today as well, just doing the weekly outlook. So prepare for that. And if you guys are a member, again, I do share those weekly outlooks. Again, what my game plan is for the week coming ahead. So make sure you guys check out the market updates channel. And I'll also kind of share some stock ideas in the research channel as well later today. But if there's no more questions, I'll end off there. Go get some lunch. And yeah, all right. So thank you guys. I hope everyone has a good rest of your weekend, and I will see you guys either in the live session later today or for markets tomorrow morning. Thanks, guys.